Away from geopolitics, we've got the Fed. They released the minutes from the December policy meeting when officials raised rates for the third time last year.
Joining us now, David Bloom, Global Head of Currency Strategy at HSBC. David, very good morning. Happy New Year.
Thank you very much.
So a lot of the geopolitical tension surrounds North Korea. There's a sort of Twitter battle going on between Donald Trump and Kim Jong-un around who has the largest nuclear button, apparently. And then there's the protests on the street in Iran. Do we have another year this year where we sort of disregard, in a market sense, the geopolitical tensions and we focus instead on global growth?
Well, I think in the FX market we certainly have. I mean, we got the Chinese PMIs yesterday, we got Singapore GDP much stronger, and we saw the dollar on the back foot, and now the dollar's made a bit of a gain. And so I don't believe we're in a political world at the moment. I believe we're much more in a cyclical world. This is about what central banks are going to do as far as FX is concerned. And if you look at the reaction of dollar Korea, you can see that it doesn't imbue a lot of politics in it, and I think quite rightly so.
Let's talk about, I mean, if it's going to be what central banks do, then what central banks do has got an impact on the bond markets, I presume. The dollar, will the dollar return to responding to bond yields? If you have a look at this, there's a disconnect between five-year paper and the dollar. Does that relationship return then? Because the dollar...
No, because the Fed is not data determined, it's predetermined. So when they're data determined, payrolls are coming out this Friday, and you get this number coming out and there's great excitement. Well, what difference does it make if we know what the Fed's going to do? The Fed says 3, we say 2, some say 1. Big deal.
Is it that preordained? Is it that preordained?
They've told us in the dots, and last year they followed the dots, yet inflation undershot massively. Yes. And they ignored it. So being predetermined means volatility is very low, and the data doesn't matter as much. But what central banks actually do does matter. And I don't think it's really just about the Fed now. I think it's about, what do the Aussies do, the Kiwis? What is, the Scandinavian central banks do? Is it broadening out? Are we still going to get rate rises? We saw the Fed go first, and then we've kind of seen the ECB move in. Then we saw the Bank of England. Then we saw the Bank of Canada. Who's next? And if you can spot who's next, that's the currency I want to buy.
So you're following the central bank story, but just because the Fed did what it said it would do in its dots last year does not necessarily mean it will this year, do you think, David? Because, I mean, the dots are just supposed to be a guide where they think they'll go, not necessarily a promise.
Yes, but, I mean, the market said 1 and the Fed delivered 3. And the dollar went down. So what relationship is there? So if we're saying the Fed do a bit more, does that mean the dollar's going up? Or is it the global growth story that does really well? And actually the higher beta currencies are the emerging market world. So when you see global growth doing well, or even a strong US number, does the dollar actually go down rather than up? So these are the questions we're grappling with rather than, what's happening between Twitter spats, etc. This is what really matters in the FX market.
Can I ask you then, I mean...
You can ask, but it doesn't mean I'm going to answer.
Listen, I'll tell you what, you arrived on this set, and if you're looking for a lippy guest, this is the personification of lippiness. Behave.
Fighting form this
He's
morning.
punching the mic. So let's talk, you said, OK, so here's a smorgasbord of central banks. I think there's possibly going to be a coordinated move higher. Is that too strong a word?
I think it's too strong. I think there's leads and lags, and the US was first out. The dollar went up massively in 2014 as the US broke through into what people thought was recovery. Then we had the ECB last year. Who's next? I think like Aussie, Sweden, Norway.
So they go. What about Japan? Could Japan be bounced into a slightly more, I don't know, tightening bias, moving off 0% targeting, moving up to 25 basis points? That could have a bigger bang in the markets than any of the rest.
Yeah, they've tried that before. The economy got slapped really badly. They went, the zero interest rate policy, let's move away from it. They raised rates and the economy just crumbled. So I don't think they're going to be very quick to do that. I mean, now that after 20 years, they're saying, well, there's this negative impact maybe of zero rates. Really? After 20 years, you've realised that? So I don't think the Bank of Japan are going, it's a great story, it feels sexy.
I like this story.
Yeah,
you want to slap me with this story, don't you?
Yeah, but it's just like, let's talk about it, and then it never happens.
OK, well, we'll leave that one there then. Back on the inflation and the Fed story, because, of course, we get the minutes later today from the latest meeting of the Fed FOMC. Yep. And, of course, inflation is the hot topic of debate. If you look at the amount they discussed it, as you said last hour, Manus, they've been talking about it increasingly, out-documented documented in their minutes. How do you weigh up the inflation debate at the moment in the United States and whether it's caused by transitory factors, or are you going to tell me it doesn't matter because the data doesn't matter because they've told us they're hiking?
Well, unfortunately, I mean, it seems they've obviously got the dual mandate in the US, unlike other central banks where they look at the unemployment rate. But if you look at the average earnings, that's what people will be looking at in the payroll. So you're absolutely right, the focus is on inflation. Well, you know, what is more important, the average earnings number or the headline, how many people got jobs? You know, and they're both equally important socially, but I think for financial markets at the moment, it's average earnings. The big puzzle is, why do the unemployment rates keep falling and the average earnings don't rise? What's happened? Where's this, you know, the so-called natural rate of unemployment? I like to say it's in the corner of a Harry Potter movie because it just doesn't exist. We've been looking for it in the UK. We said it was 7, 6.5, 6, 5, and you know, and then it
kept crumbling.
Just kept crumbling. So yes, the inflation debate's essentially important, but I think the Fed is much more predetermined than data determined in their forward guidance, and therefore volatility remains low.
OK, we had a drop in the dollar last year, the first yearly loss since 2012, something which came out yesterday. We saw the CFTC data a week behind, but we've gone net long for the first time in 6 months. Everything that you've just said now, what happens next for the dollar? Let's get some calls out of you. Dollar, Q1 through to Q4, and your dollar yen. Let's start with those two, and we'll move on to the others.
So I'm saying, look, the dollar is slightly weak, but what I'm saying is it's a pick and choose. I mean, like in equities, you'd say it's a stock pickers kind of environment where there's no bull market like in 2014, 15 in the dollar. There's no bear market. What there is some currencies are going to do very well, some currencies won't. I mean, for example, dollar yen, we've got going to 108. Now, you're going to go from 112 to 108. This is a forecast. Yeah, it is a forecast, but it's in the opposite direction to the consensus. Most of the consensus think dollar yen continues to drift higher. We think it drifts lower. But as I said, there's no smash, bang, wallop when it comes to dollar yen. They're more interesting, like sterling. We've got, as you know, we've still got sterling weakness coming around this year. But euro, we've got like kind of drifting sideways.
We've touched on a couple of themes, syncopated, or not syncopated, but a move higher in rates. That's what the central banks want to achieve. Commodity markets are on the run higher. Synchronized global growth. Tie it all together. Do I want to be long Aussie, Kiwi, CAD? How do I want to play those currencies?
I mean, if you talk about that triangle, which is commodity markets, kind of dollar stability in terms of policy markets, and China, that's brilliant for emerging markets. That's a triangle of beauty for emerging markets because you've got, you know, stability in rates. OK, they might go twice, they might go 3 times. We think twice. Fed says 3, market says 1, big deal. Commodities are doing quite well, and China is stable. This is a great environment for emerging markets.
So EMFX, is that one of your big calls for 2018? And where do you express that? Where's the interest?
Well, I mean, there's still some we like and some we don't like. We're talking about commodity markets. You want to go for the commodity play. That's the ruble. We're very positive disposed for the ruble for cyclical and structural reasons. So we like that. We like India. So, you know, there are lots that we do like. I mean, like the Rand and Turkey, we're not so keen on. So there's those you like, those you don't like.
Why structurally on the ruble? Obviously, the cyclical story could be around the oil price coming higher, but what about what's the structural change you see there? Well, the structural
change is that we're starting from, if you look at the current account deficit or the fiscal deficit, it's not huge and enormous. You're not starting off something where you've got massive deficits and then you're starting. What you're starting off is they could still build bigger deficits. They could still have a much bigger current account 2-3 years down, and then you start worrying. But for the moment, you don't have to worry about that, and that's excellent news, because current account deficits and fiscal deficits are big worries for emerging markets, particularly big current account deficits.
One of the functions that Anna discovered this morning at 3:30 was the flow of funds. The flow of funds into the UK.
FOFP.
FOFP. Take a look at it. We touched on it from the equity point of view with Edmund Ching, but this is the flow of money in stocks into the UK, and indeed the overall flow of money. Now, this is, some would say, part of the support system behind sterling. Do you see that flow continue? This is American money into the UK, so it's that question of whether that continues.
If you've got a big current account deficit, people have to finance it somehow, and the way they finance it generally in the UK, or did, was through buying financial assets in the UK. some fixed investment as well, but financial assets. So generally, portfolio flows have to come into your country, or investment flows, if you've got a massive current account deficit.
And you talked about that in the context of emerging markets as being a concern. Is that a concern for UK assets, concern for sterling?
So the difference is sterling is starting off with a current account deficit of 4% plus. I'm saying 4 because they keep changing the number. They tell us it's 3, that's 5, let's call it 4. So in the UK, starting with a big fiscal deficit, a big current account deficit, and big political problems. Why would I want this currency?
Well, why is it bid? I mean, is that because...
Bid? Well, 135, you're getting excited now.
Actually, yes, I am. It's nearly at 130. I'm nearly at 136. I'm surprised that it's not lower. If you pick everything that you've just said, then why is it not trading at 120?
Time. You
can't buy time on this show.
No, because what I'm saying is you've got fantastic opportunity when a currency becomes overvalued, like sterling, so you can sell it at 135. Isn't that beautiful? I mean, look, just because you had to pick it up with a paint scrape off the floor when it hit, 117 the one day, you get excited 135. Fair value should be 155 of this currency. So it's got a structural, cyclical and political problem. All three. Yours.
I was going to ask you what the catalyst would be, but it sounds like there could be many then from the politics.
Well, there are lots. There are lots of different factors. Don't forget we're at the heart of optimism at the moment regarding Brexit, and from here I think things could still get very difficult, as you know. Structurally, current account deficit, fiscal deficit, political problems, and cyclically meant to be one of the underperforming economies of the G10 at 1.5% roughly growth. What do you like about it? Well, what do you like about it? Now, what's your turn, big shot?
We earn it. We earn it. I suppose that's what we're looking at, David.
I don't want to be called out.
We have to declare. Yeah, we'd have to declare long sterling.
Absolutely, which I don't have any trading positions whatsoever.
No, not on a trading perspective. Just
from a trading perspective, it's not a question of being a big shot. What I find interesting is that you've just sort of said we're at peak optimism. I mean, is that what people are actually saying out there on trading floors? There's this sense of relief, a palpable sense of relief.
Well, there has been. We saw as the negotiations got closer to the wire, something we should have negotiated a year ago got negotiated recently, and everyone got optimistic about it. And that propelled sterling higher.
Do you think the border issue, I mean, we've done a lovely piece this morning, the base case scenario, the upset scenario, and the walkout scenario in terms of the Brexit scenarios. As you all sit together, what is your base case scenario that we scrape through,
that is the case. Yes, that's, I think, the central case. But getting there is not going to be smooth trajectory. Before we get there, I think people are going to get very worried. And we saw the last negotiation went to the wire. It looked like it wasn't going to happen, and then you get to the edge, oh, yes, it is going to happen. Okay. And so I think there'll be a lot of tension.
David,
that okay means I've got to go. All right.
Thank you very much.